Hello and good morning, everyone. Thanks for joining us once again for our latest Pulse Advisor webinar. My name's Paul Foreman, International Sales Manager at Novia Global. I'm delighted to say that we're being joined by M&G for this latest edition. Today we have Andrew Eve from M&G, and he's going to talk about the macro trends and investment opportunities from a fixed interest perspective. And I know this has been a very topical subject for us to cover off, particularly given the current inflationary and interest rate environment that we're operating in, and the impact that the changes can have in the wider economy and the financial services environment that we operate in today, particularly, for example, with the likes of defined benefit transfer values. I know that's a topic I've discussed with many of you in recent weeks, and how the interest rate changes in the wider economy have been impacting financial planning in ways like that. In the usual way, if you have any questions, there is a button at the bottom of your screen. Fire away, and we will have a session at the end to cover off any questions and answers. Anticipating the slideshow taking about 30 minutes today. Without any further ado, I'll hand you over to Andrew. Thank you, Andrew. I think we're having an issue with the audio there, and maybe you have to unmute. There we go.
There we go. Is it working now?
Perfect. Yep, away we go.
Perfect. Well, good morning, everyone. As Paul says, just an introduction on, if we can skip on to the 2 slides forward, I think, just some introductory slides there. But there we go, and just one back. So the topic of today is just a 2023 outlook from the point of view of fixed income, and in particular, our macro views and how that translates into how we think it makes sense to invest within fixed income at the moment. And the theme of the presentation today is that bonds are back in 2023, and we do believe that we see a lot more value within fixed income as we continue through 2023 than we have for quite a long time. And in particular, I'll talk through in a moment 3 pieces of good news that we see within fixed income markets at the moment, our outlook for the rest of 2023. And then in particular, I'll come on at the end to talk about how we think it makes sense to be investing in fixed income. Having explained why we think now is a very attractive time to be looking at fixed income markets, I'll try to give a bit more context around why we think, or rather how we think it makes sense to invest in fixed income, and in particular, how we think an active approach is key. But without further ado, I'll start with our 2023 outlook, and in particular, 3 pieces of good news that we see within fixed income markets. So just to set the scene, we saw over the past couple of years a huge increase in money supply, and of course that resulted in a lot of inflation. We hear plenty of commentary from central banks and other commentators about very idiosyncratic reasons. And if we think back to 2020 and 2021, there was plenty of talk of supply side constraints, shipping costs, idiosyncratic drivers. And all of that was true to some degree as a cause of inflation. But in our view, the main cause of inflation was a lot simpler. We printed a lot of money during that time to bridge the gap during COVID lockdowns. For the first time in many years, we had both fiscal and monetary policy working in concert, governments and central banks both pursuing very accommodative expansionary policy. And no surprise to see thereafter a lot of inflation. What this chart shows is M2 money supply, which basically shows how much money is there in the economy. And you can see that compared to the pre-COVID trends, we had this huge bubble of liquidity enter the system. So there was more money in the economy, no real growth to take that up. And therefore, in our view, it's no surprise really to see quite a lot of inflation in the system. So we do think it's quite a monetary phenomenon, inflation at the moment, and the inflation that we're seeing now. The good news is that, as you can see at the very right-hand part of the chart, does seem to be coming down. Central banks have managed to tighten financial conditions and start to withdraw some of that excess money out of the system. But this was the bad news for 2022, if you like, just to set the scene. This was why we struggled in terms of fixed income performance and other asset classes. We had a lot of inflation, markets adjusting to this new inflation period. And if we move on to the next slide, we can see what that bad news for 2022 led to. A very difficult period, as we all remember, for being an investor, whether you were in equities, fixed income, any sort of investments really. So we've got here government bonds, corporate bonds, emerging markets, currencies and equities. And even for a very diversified portfolio, 2022 was a very difficult year. And of course, that was the bad news for 2022. But moving on to the theme for today, the three pieces of good news. Why do we think that 2023 is a much more constructive starting point for fixed income? And if we go on to the next slide, we've seen the bad news for 2022, which was the big increase in money supply and inflation. But as I said, there is evidence that central banks have been very successful so far in tightening financial conditions. This chart again shows money supply in the light blue line, and we put it with an 18-month lead, because typically we think that it takes about 12 to 18 months for monetary policy to actually feed its way through into the real economy. This is what makes central banks' job quite difficult, because they're always looking at current data and having to set monetary policy for 12 to 18 months in advance. But that's why we've shown money supply with an 18-month lead here in light blue. And you can see the big increase in money supply that we saw during 2022 and 2021. But you can see that, as I say, central banks have been successful in tightening financial conditions and taking some of that excess money and that excess liquidity out of the system. If we look at the dark blue line, US inflation, we see it tends to follow money supply, as we would expect in our team. And while we wouldn't necessarily expect inflation to fall down quite as sharply as the money supply line, you can see that the trend is so far that inflation is tracking that decrease in money supply down. So that's the first piece of good news. Inflation is on a downward trajectory. There are elements of inflation, as we all see in the economy, that are becoming very sticky and persistent. It won't be a quick job, I think, to see inflation come back down. And I think we'll probably see inflation settle to a slightly higher regime than we've seen for some time, maybe 3 or 4% for some time, rather than getting straight back down to 2%. But the general trajectory does seem to be a positive direction downwards. And that should provide a tailwind for fixed income in our view. Inflation rising during 2022 made it a very difficult position for being a fixed income investor, but that lowering inflation should, in our view, provide some tailwind to fixed income during the next year or two. So that's the first piece of good news. On to the next slide, the second piece of good news we see at the moment. Now, there's plenty of discussion about whether growth is slowing and might we enter into a recession. But in our view, in many ways, the economy is in quite a strong position. And in particular, a very important question in our view is not so much will we see a recession at the end of this year or next year, perhaps, as seems to be market consensus. That's not so much the question, will we have a recession? But the more important question for us is what sort of recession might we have? And of course, the two recessions we're all most familiar with were 2008, the financial crisis, and the 2020 COVID pandemic. Both very severe recessions. In the latter case, the entire global economy shutting down. So we're used to thinking of recessions as being extremely severe, but with the economy, in our view, in a much more resilient starting point than it was in those previous positions, we do think any slowdown we see will be of a more mild form. In particular, on this chart, we can see there's plenty of people talk about leverage increasing in the system, and that's true. But one of the important changes we've seen since 2008 is that a lot of that leverage and that debt has moved out of the private sector. On the left, we've got household debt as a percentage of GDP, which you can see has come down, moved out of the private sector and into the public sector. You can see on the right-hand side, federal debt as a percentage of GDP. So leverage has moved from the private to the public sector, and that makes the private sector a lot more resilient than it has been in the past, and adds to our view that we think if we do see a slowdown, it's likely to be of a more mild to moderate form than perhaps we've seen in previous slowdowns. And on the next slide, in the same vein, we do see plenty of strength in the labour market, not just a little bit of strength, but a very, very strong labour market. These two charts, we've got on the left, the US, and on the right, the UK. And what we show here is an indicator of the labour market that we've always liked to look at in this team, rather than just the headline unemployment rate. And what these two charts show are the number of unemployed people in green, and then the number of job openings in blue. And typically you'd expect to have more unemployed people than there are job openings. But actually, what we see at the moment in both the US and the UK is actually the very unusual situation of having more job openings than there are unemployed people. You can see the big spike in unemployment we had during COVID, but that has very much come down. And as I say, we're now in the very unusual position of having actually more job openings than there are people who are unemployed. Now, of course, there are frictional issues with employment. It may be that there's skill shortages. We've seen trends after COVID, for example, people moving back into education. Ooh, switch the lights back on. Sorry about that. So we've got our environmentally friendly lights, which automatically switch off if I don't move. So there are frictional issues with employment markets. As I say, we've seen people move, for example, maybe out of the employment market back into education following COVID, or into earlier retirement. But all in all, that has meant that labour markets have looked very strong over the past couple of years. So all that is to say, the starting point for this economy does seem to be a very strong one. And while we may see a slowdown in growth, we do think, based on the starting point that we're at in some of these indicators, very strong labour markets, leverage having moved from the private to the public sector, that we're actually in quite a different position to that which we were in previous cycles. And then the third piece of good news on the next slide is that we think now is a very attractive time on a valuations basis to start your journey into fixed income. Now, this is one of the most important charts to look at, I think, as a fixed income investor, because what it basically shows you is, in real terms, how much money can you expect to make on a fixed income investment. And what it shows is the 30-year US Treasury yield over time in real terms, so after the effect of inflation. And you can see we've been, over the past few decades, in two sort of, or three maybe, regimes where we've had the kind of 2% real yields, then kind of 1.5%. And then we ended up during the period of COVID, where government bond yields went very low, supported by central banks, of course, and we saw real yields of close to zero. Yields were very low, bond prices were very high. That was a very bad starting point to begin one's journey into fixed income. And we saw that during 2022. It was a bad point to start investing at the beginning of that year. But what we've seen since is, yes, a very painful performance generally across the board during 2022. But the other side of the coin is that fixed income valuations now have entered a much more attractive territory for us, back to these kind of 1.5 to 2% real yield levels. So we do think that now it is a very attractive point to start one's journey into fixed income with much higher yields, or lower prices, in other words, than we've seen for some time. And on the next slide, continuing on the same theme of valuations, one of the nice things about investing in a corporate bond is that you have two components within that bond, two drivers of return: your risk-free rates component and your credit spread. The risk-free rates component, of course, being government bond yields, and the credit spread being how much do you get paid as an investor for investing in corporate bonds over and above investing in government bonds. How much do you get paid to take that extra credit risk? And typically those two elements have a somewhat inverse relationship, because in times of bull markets, you'd expect credit spreads to tighten and do well, but maybe risk-free rates will sell off a little bit as markets perhaps expect higher inflation. And conversely, in times of a bear market, typically risk-free rates will rally as people invest into government bonds, and credit spreads will sell off. So those two elements, the risk-free rate component and the spread component, tend to be somewhat inverse correlated. They have slightly separate drivers throughout the economic cycle. And that provides some degree of inherent diversification within corporate bonds, which is one of the things, in our view, that makes them quite attractive. One of the issues, particularly during 2020, 2021, 2022, was that, as you can see on this chart, which shows the makeup of that total yield you get on a corporate bond by, as I say, the risk-free rate component in blue and the credit spread component in green. As you see, during about 2021, that risk-free rates component was very, very close to zero. So there was very little space for yields to rally anymore. And that meant that this natural diversification benefit that perhaps is within corporate bonds at certain times in the cycle was not possible because there was very little room for risk-free rates to rally. But what you can see now, looking at the chart today, is that both those two components are alive and well. We've now got risk-free rates at healthy yields, providing a bit of cushion if we do see a risk-off environment. And likewise, the credit spread component, again, offering a decent amount of cushion there. And so we would expect that natural diversification benefit to be slightly more attractive now than we've seen. And of course, as well, just looking at the headline number on that yield chart, just looking at the very top of where the two area charts combine, if you follow the line along left from there, you can see even just on an absolute headline basis, we're at valuations within fixed income now that are pretty much the cheapest we've had for maybe a decade. So again, a very attractive entry point in our view to start one's journey into fixed income. There could be some more volatility ahead. We've still got central banks probably doing a little bit of hiking still. So I do expect there'll be some more volatility to come. But for a medium to long-term investor, in my view, this is a very attractive entry point to be looking at fixed income. So we've seen here the natural diversification benefit you get within fixed income, particularly within corporate bonds, the risk-free rate and the spreads component. And on the next two slides, I'll just look at those two components, so the risk-free rate component and the credit spread in more detail. So firstly, on this chart, the risk-free rate component, here I've chosen 5-year gilts. You can see the gilt yield along the left over the past couple of decades. And of course, the trajectory for most of the time has been downwards until very recently. And what we've plotted here is just some price return scenarios. Now, we used to show this chart back in 2021, and you can see that in 2021, yields were pretty much close to zero. And we would show that chart to show clients that in our view, there was very little value in investing in government bonds. And you can imagine all of those price return scenarios were negative because there was very little room for yields to rally any further, but there was plenty of room for yields to sell off. And so all of those numbers pretty much would have been negative. But now we're in a very different position. And you can see that if we do see yields rally by a couple of percent at the 5-year part of the gilt curve, you're looking at potentially 10% sorts of returns. So there is a lot more value now back within, firstly, that risk-free rate component, as you can see here. And secondly, on the next chart, looking at the credit spread component. Now, of course, that credit spread is, again, how much am I getting compensated for lending to a corporate over and above a government? In other words, how much am I getting paid for that default risk? Because that's really the difference between investing in a government bond and a corporate bond, the higher risk of default. Now, it's possible to work out backwards from looking at what credit spreads you have on a corporate bond, what proportion or what frequency and percentage of defaults is the market pricing in. So let's say you have a 0.4% credit spread for a 5-year bond. That's telling me that 0.4 times 5, then you can work out what sort of default rate you're expecting. And that's what we basically show on this chart here. What is the implied default rate versus average and worst default rates over time? So what you can see is in green, the implied default rate, and then in blue, the average default rate that we've seen over the past few decades, and then the worst default rate in pink. Now, looking at the first 3 credit ratings here, the investment grade ones, AA, single A, and triple B, you can see that the implied default rate is much greater than the average and worst default rate we've seen over time. So we do think that within credit markets, we are being quite well compensated for the default risk that we're actually exposed to at the moment. As I say, in our view, we do think that if we do see a slowdown in growth, it will be of a more mild to moderate form than perhaps we've seen in previous scenarios as well. So based on that as well, we do think we're being quite well compensated for defaults at this level. And just to return to that calculation, I think I mixed up what I said, but it's to clarify, let's say you have a 2% credit spread and a 5-year bond. What that's telling me is that 2% divided by 5 years, I'm being compensated for 0.4% default risk every year. So that's the calculation we're doing here, taking into account as well recovery rates that we would expect within those bonds. But basically working out backwards from the level of credit spread we're receiving, how much default rate do we expect over time? And as you can see from how much higher these green bars are than the actual average and worst default rates, we do find that we're quite well compensated for the default risk that we see in the market at this point. And then on the next chart, just one last one on the theme of valuations within fixed income. Again, one of the issues with trying to make a case for investing in bonds over the past few years has been that yields were very, very low, and maybe even if people thought that equities were a little bit overvalued, apologies, I'll just switch the light on again. There we are. So one of the challenges with making a case for investing in bonds over the past few years has been that even if people thought that the alternatives, for example, equity markets, were quite overvalued and a little bit expensive, at least they were offering some sort of yield. Whereas, as you can see, corporate bonds and bond markets were offering very little yield. You can see that on this chart. What we've got is the S&P 500 earnings yield, so the inverse of the PE ratio. What sort of yield do you get? And also we've got US mid-dated BBB, so investment grade corporate bonds, the yield to maturity. And we show earnings yield and yield to maturity here to try and get some sort of proxy of being able to compare equity and fixed income on a somewhat like-for-like basis. And as I say, during 2020, 2021, it was quite difficult to make a case for investing in bonds over equity. But actually now what we see is corporate bonds offering a similar level of yield to equities, with, of course, a lot less risk given where they are within the capital structure. So we've gone from this environment of having there being no alternative really to investing in equities for a mainstream portfolio, to now there very much is an alternative. Fixed income valuations are now back to very attractive levels in our view, both on an absolute basis and relative to other asset classes, as this chart shows. Okay, if we move on to the next slide. So those were the three pieces of good news in our view for fixed income. We had the bad news during 2022, inflation picking up following all the monetary stimulus that we saw into the economy. And no surprise really with all that excess money in the system to see that inflation picked up. And that was bad news, not just for bonds, but also for most asset classes. That was the bad news for 2022. But three pieces of good news for this year as we look to invest within fixed income. Firstly, while there is still some way to go, we do think the trajectory is downwards for inflation. So it's moving in the right direction. And that should provide, in our view, a tailwind for bonds. Secondly, we've got, yes, some risk of a slowdown, but we do think that the starting point we're in the global economy, if you look to things like where the leverage is, and as we saw, it's moved very much from the private sector into the public sector, or if you look at things like the labour market, which does appear to be extremely resilient at the moment, we do see that probably we're in quite a strong starting point. So even if we do see a slowdown, we'd expect it to be of quite a sort of mild to moderate form. And then thirdly, the third piece of good news is that valuations at this point are very attractive. For a medium-term investor, we do think now looks like a very attractive entry point to start one's journey into fixed income, both on a absolute basis. And we saw that within credit markets in particular, within investment grade, we do think we're compensated quite well for the sort of defaults we might actually see. And likewise on a relative basis compared to equities. So those are the pieces of good news for fixed income. Now, if you do agree with us that fixed income is looking attractive now, I think the next question is, well, how to invest in fixed income? And in our view, fixed income really is an area in which an active approach pays, in which there are a lot of opportunities to add active value. And if we go on to the next slide, just to introduce this point, fixed income, perhaps we're used to thinking of as, your slow, steady, slightly boring part of your portfolio. But this chart is just to show that your active decision in what sort of fixed income you invest in can result in a very different return profile, just to refresh our minds of what happened last year. In green, we've got the sort of portfolio that we perhaps imagine fixed income to look like, slow and steady and not really doing too much. And this is a fixed income portfolio that's short dated and very high in credit quality. So that did very, very well really in 2022. Then we've got equity, the S&P 500 marked in blue. And then the two other lines, we've got fixed income, but with some higher risks, either higher term risks, so longer dated bonds in the orange line, or fixed income with higher credit risk in the pink line, so taking lower credit quality bonds. And really, this is just to set the scene and point out that what you invest in within fixed income does matter. There are opportunities to deliver very different return profiles. It's not just a homogeneous asset class. There are very different return profiles available depending on the sorts of decisions you make. And as you can see during 2022, that really was very true. If you'd invested in very low duration, high credit quality bonds, you'd have seen a very different return profile to investing in long dated bonds, for example. On the next chart, we can see, again, credit markets are a very deep, diverse and growing universe. They're not the small markets they once used to be. You can see global government bonds on the left, investment grade corporate bonds in the middle, and high yield on the right. Total amount of debt outstanding in $1 trillion we've got here. And as you can see, over the past decade even, these markets have pretty much doubled in size. And with that comes a lot of opportunities for active risk taking. There are inefficiencies in these markets. We do believe that corporate bond markets in particular are not efficient, don't sort of price efficiently. And this does create pockets of value for active investors, whether it's relative value or new issue trades, or that sort of thing. So they are very deep, diverse and continually growing investable universes that we have access to within fixed income, which offers us plenty of opportunities as active managers. And on the next chart, continuing in the same vein, you can see the importance here of being flexible. So what we've got here, this chart shows along the horizontal axis, we've got different credit rating bonds. So moving down in credit quality from AAA down to BBB within the investment grade spectrum of corporate bonds along the left, along the bottom axis. And then on the left, we've got the option adjusted spread. So just the credit spread, how much credit compensation am I getting for investing in a corporate bond over and above a government bond on the left. And you'd expect generally that the higher risk bond you're lending to, in other words, the lower credit quality bond, the higher spread you would get. And you can see that trend is generally true. You can see the numbers tend to increase as you go down in credit quality from the left to the right of this chart. But what you can also see, particularly within the BBB space, is still a great deal of dispersion within these markets. So it's not the case that just investing in an index, necessarily you get exposure to a very efficiently priced set of bonds. And it's these sorts of areas where we can try to add value, because if we do agree with the credit rating of BBB plus, for example, of one bond, you can see that there's opportunities to harness spreads of around 800 basis points, so 8%, all the way down to around 100. And that does offer very different valuation opportunities. Obviously, we'd be trying to invest all else equal in the ones with a higher spread. So plenty of dispersion within investment grade bonds and plenty of opportunities to try to deliver active value. And this is where having an understanding of the companies you're investing in, taking an active approach, doing research on the sorts of companies that you're investing in becomes very important, because we can decide, do we agree with the credit rating being BBB plus? Do we think it's just very cheap versus the actual fundamentals? Or is there something else going on? It's not really BBB and we don't want to own it. And these are the sorts of active decisions that we try to add value with. And on the next chart, just to make that point in another way, with a JP Morgan bond, for example, if you're investing in the stock, you've got one decision really: do you buy it or sell it? This is just a fixed income search of JP Morgan bonds, and you can see there's more than 2,000 bonds available. So it becomes a very different way of investing, a lot more opportunity to try to add active value. Bonds here, which are in different holding companies within the, or different structures and different companies within the JP Morgan structure, ones of different credit rating, ones of different seniority, and ones of different levels of liquidity, for example, given the different amounts of debt outstanding. So all sorts of decisions to try to make and opportunities to try to add value. So again, in fixed income, we do think it really is an area where an active approach can pay. And just moving on to the next slide, this is an area we do have expertise in within M&G. This is an area that we think sets us apart. We do have a very significant resource of fundamental credit research analysts. You can see the team on the left. I'll just talk briefly on this, but we do think they're possibly the largest team in Europe. We don't know, but we don't know if there's any larger teams. So we believe they're the largest team within Europe. The analysts are sector specialists and career analysts. So we don't follow the model where analysts will cover a sector and then be promoted to become a fund manager. Rather, the credit analysts cover their sectors for their whole careers. And that means they do build up a lot more in-depth knowledge of the sectors and companies that they're covering and enable us to decide, are we being compensated correctly or overcompensated or undercompensated for investing in certain corporate bond issuers. So these are very much the engine room of our fundamental credit research views and an area where we do think we can try to add a lot of value within fixed income. Just moving on to the next slide. So that's a summary of, I suppose, our views on fixed income at the moment. As I say, we do think bonds are very much back in 2023, having had a somewhat uncompelling period for bonds within 2021 and 2022. We do think now that there is some very good news for fixed income investors. In particular, valuations look very attractive. Just apologies, just switching the light on again. In particular, as I say, valuations wise, we do think that now looks like a very attractive entry point for a fixed income investor over the medium term, based on both absolute levels of valuations here, but also relative valuations compared to other asset classes. And then I've just spoken there a little bit on how we think it makes sense to invest in fixed income. And the key is to be active. We think it is a very inefficient, diverse market, and we do think there are opportunities to add real value if you take an active approach here. And as we saw on the first charts there, you can see very different return profiles depending on the sort of fixed income you invest in. So active decision making is quite important here, we think. I'll just conclude with a very brief summary of all that in practice. So there's all the theory, why we think fixed income looks attractive, why we think an active approach makes sense. Does it all work? Well, this is our one of our flagship funds, the M&G Optimal Income Fund, which I'm sure many of you are familiar with. I'll just very briefly go through one or two slides on this just to put it all into practice. As I say, it's our most flexible fund, I think, a fully flexible bond fund. We do also have the ability to invest a small amount within equities, but mainly we've got 0 to 100% exposure to government bonds. We've got the flexibility to take 0 to 100% in investment grade, and the same within high yield bonds, and a duration range between 0 and 10 years. So we can take a very active approach here, add all the best ideas of the fixed income team, and enable the fund manager really to express their pure investment view within this very flexible strategy. On the next slide, and perhaps if we just go one more slide forward to the line charts, as I say, just putting that all in practice. Does active management work? Well, this is the performance of the fund over time since its launch. You can see on the left, we've got the fund in green versus other sectors, whether it's the investment grade corporate sector, high yield sector, the gilt sector, so other alternatives you might have invested in that are more passive, for example. And you can see the fund has managed to outperform all of those over the long term. And likewise, on the right, we've got the fund in green against its benchmark. So just wanted to finish on that, just to put it all into practice and show that the active management does work. And one last slide on the end, I think, before I hand back to Paul. If you are interested in more of our macro views and our views on fixed income markets, I would recommend taking a look at our Bond Vigilantes blog. We've been running this since, I think, 2006. And the team back then, well before I joined, were blogging on their concerns about the US mortgage market all the way back then. And you can read our fund managers and investment specialists' views today if you have a look at Bond Vigilante's blogs on everything from Brazil emerging market research trips to US inflation. So do take a look at that if you're interested in reading a bit more about our fixed income views. With that, I'll thank you all very much for your attention and hand back over to Paul. And apologies for all the lights keep switching off.
Don't worry there. I've left mine off, Andrew, so we'll be okay. Yes, thank you for that. Some great insights into what is a really topical area at the moment, and hopefully gives some great information for advisors to share with clients when receiving questions in this area. So talking of questions, we have had some from the floor. So without any further ado, if I can get you ready, Andrew, with a couple of these. The first one we have is, with the increasing popularity of sustainable investing, how do ESG factors play a role in fixed income investment decisions, particularly in an environment of rising inflation?
Yeah, good question. And yeah, this is a really growing area, as we all see within all investments, perhaps a bit, typically associated a bit more with equities. It's a bit more obvious perhaps to see the ways that ESG can be integrated there. But we do find still ways to integrate ESG within our funds. So the first way is to really understand, I suppose, from the credit research point of view, we've always tried to have a very in-depth understanding of companies. And in many ways, ESG is kind of an extension of that, trying to understand the sorts of risks that you have lending to certain companies. Because remember, if you're a fixed income investor, what you're trying to do really is avoid the downside. There's not much upside. You get your money back, and hopefully you've bought a bond at a good valuation. But what we're really concerned about as fixed income investors is avoiding the losers. And so if you are looking at companies, the types of things we are perhaps looking at is stranded asset risk. If it's maybe an energy company and we don't think they'll actually be able to monetize assets they have, whether it's risk from social issues as well, or risk from governance, again, very important within fixed income. So there's the ESG integration element within the research process, which, in many ways is a kind of natural extension of the way I think it makes sense to invest in fixed income, really understanding the risks. And then on the more, interesting side, I guess, or more exciting and novel side, there's the kind of green financing and social financing. And we're seeing an increase in green bonds being released, and also blue bonds, which are for ocean-based projects, transition bonds, which aim to help energy companies, for example, transition to more sustainable business practices. I think the main thing to watch out for here is greenwashing, as I think many of you will have come across. It is an area where we need to make sure that the proceeds of these bonds are actually being used to finance the things that they are. Where there's penalties, for example, in the bond frameworks for failing to meet certain targets, making sure that those penalties are actually meaningful. And anecdotally, you see some where it says, oh, we'll have a coupon step up if we fail to meet certain green targets, but the coupon step up is 0.1% or something, not economically meaningful. And so it's a growing area. But yeah, there are ways within fixed income that we can try to still have an impact within ESG.
Great stuff. Thank you, Andrew. And on one of your earlier slides, you showed us currently we're seeing more job offerings available than the unemployed people out there. So we're being asked, in that kind of scenario, do wages tend to go higher and subsequently push up inflation? And in that context, would we expect to see interest rates rise further to tackle such inflation?
Yeah, very good question. And this is exactly the concern of central banks at the moment, is inflation becoming sticky. Now, we have seen some encouraging news, particularly in the US, where inflation does appear to be coming down. Of course, we saw, I think today, the UK CPI going very slightly down. Nothing to get too excited about yet, but let's hope that's a move in the right direction. But yeah, the concern is that inflation starts to become embedded in stickier components, wage increases, food prices. And, I think in the UK today, though the headline was down, I think still the median and the core was still quite elevated. And yeah, wages is a big part of this because, as we all know, if people ask for wage increases and just increase their real spending power back to what it was, then it will just result in more inflation the next year. So this is the difficult thing for central banks to try to navigate. And yeah, I think I agree that the very strong labour market is a headwind to trying to get inflation under control. But yeah, I suppose interest rate hikes are clearly starting to feed through into the economy. One of the things, as I mentioned, is that monetary policy does tend to act with a lag, but monetary conditions have tightened quite a lot now. So we'll see. I think the UK has a harder job again because we've got a very short-term mortgage market, with the average duration of a mortgage being 5 years, as most of us will probably have. That means that 20% of people typically will be refinancing their mortgages every year if you assume those 5 years are evenly distributed. And that means I think it's difficult for the Bank of England to keep rates in restrictive territory for too long, which makes their job difficult. But yeah, we'll see what happens. I suppose we've had some of the other things like energy costs starting to come down. It does appear food prices have started to come down at the wholesale level, but I think the challenge there is getting supermarkets to actually pass those on. So yeah, so in simple answer to the question, yeah, the labour market being strong is a headwind, I think, to getting inflation under control.
Great stuff. And one final question for you at the moment, Andrew. Do you see any value in any specific areas of credit at the current time?
Yeah, good question. I think, yeah, well, one sector-wise, financials, we still see quite a lot of value in. Obviously, we had all the stuff with Silicon Valley Bank and Credit Suisse, but still on a valuations basis, financials do look quite attractive. In particular, we think financials are in a much stronger position than they were in 2008, and still in many ways are perhaps a bit penalised by the market. For, just in sentiment terms, people still worry, I think, about financials. But this is an area where, again, we've got the team of financial credit research analysts who look into the actual balance sheets and depositors and income statements of banks. And in most of the mainstream banks, because regulation has increased so much since 2008, we actually see them in very strong, well-capitalized, liquid positions. So financials is an area where we do find a few opportunities, just because valuations look quite attractive compared to fundamentals. And then I suppose ratings wise, as we saw on the charts, triple Bs, I think, are the area within investment grade where we see lots of value, partly because there's plenty of dispersion within triple Bs in valuations, and also because if we think back to that implied default rate chart, we do find that compared to the default rate risk that we'd expect within triple Bs, we're being quite well compensated for that within that space. So yeah, triple Bs and investment grade, I think, mainly. I think high yields, there are still opportunities, but it feels to me a little bit closer to fair value at this point in the cycle. But I think within investment grade, there's still some very attractive valuations out there.
Great stuff. Well, no further questions from the floor. And I think the lights are due to go out again there any second. So we'll let you relax now, Andrew. Just leaves me to say thanks for your input this morning. All very useful stuff there. To the audience, on the 21st of June, that'll be the date for your diaries for our next webinar with Evelyn, our investment partners at Evelyn. And watch out in your inbox next week. The latest Pulse newsletter will be coming out and hitting your inboxes. And as always, we will be sending a recording of today's session. And if you have any friends or colleagues who want to join us in the future, make sure they sign up to get the updates from us. And with that, I'll just say, Andrew, once again, thanks for your time today. And to the audience, thanks for dialing in, and look forward to seeing you soon. Thank you. Goodbye.
Thank you all very much.